Today, we're going to be talking about what are typical land contract terms. Throughout this video today, I'm going to break down all of the land contract terms to help you avoid any mistakes and make sure that you're utilizing land contracts in the right way. You've probably heard the term land contract before, but are you comfortable on how to utilize it? Are there certain items and terms within a land contract that could benefit you as a buyer or as a seller? Well, stay with me as I dive into these questions by first explaining what a land contract is. Next, I'm going to cover the terms that you need to understand within a land contract. And finally, what strategy is best utilized with a land contract. If you're ready, let's go. A land contract is a legal agreement for a seller finance purchase that doesn't involve any banks or mortgage companies. It is between buyer and seller negotiated terms where the buyer makes periodic payments to the seller over the course of the loan until the loan is paid in full. A land contract is also called a bond for title or contract for deed. So what are the mechanics within a land contract? So number one, you obviously have the sale price of the property. Now understand that the buyer that's coming and buying this property from you and you're utilizing a land contract, typically this buyer isn't able to get traditional financing, so everything negotiated might be a little bit higher because you're taking a risk as the seller by seller financing this piece of property creatively to a buyer who cannot qualify for a traditional loan. Which brings me to the second point, which is interest rate. Typically, you're going to charge a little higher interest rate than what the current market is charging right now. You can negotiate a down payment. Sometimes with the land contract, because a buyer isn't able to qualify, it might be a financial reason. Sometimes there isn't a down payment or closing costs. And you also got to negotiate another piece, another element within a land contract is the periodic or monthly payment. Another component is the amount and balloon payment when that will happen. So traditionally within a land contract, when the buyer is buying it from the seller and you guys are utilizing a land contract, at some point down the road, it is in the best interest of both the buyer and the seller to have a balloon payment. A balloon payment is just a large payment that pays off the balance of the loan at a certain date down the road. Now that balloon payment might be 5 years, 10 years, 15 years down the road, but eventually you as the buyer in a land contract, you want to be able to pay that off at a certain date in the future to get traditional financing because your payment most likely is going to be less because the interest rate's going to be less. So that needs to be negotiated in there too, the amount and the date of a balloon payment. Obviously the loan term, how long is the loan for? Is it a 15-year? Is it a 30-year? All that's negotiable. Another important element is something called equitable title. This is important for the buyer because this is evidence that the seller doesn't have any other liens and he can't sell it to anybody else during the term of this land contract. And something important to note here as a buyer is you have equitable title, but the seller, all the way throughout this entire period of the land contract, he has legal title. You also need to negotiate who pays the taxes, who pays the insurance, who pays the repairs, maintenance, and upkeep. And typically in a land contract, that is the buyer. It would also be good to have in the land contract a default clause. What happens if the buyer misses a payment or he defaults on the land contract? Because the land contract absolutely benefits the seller, and the seller can act as if they were the landlord but has none of the landlord responsibilities, meaning that if the buyer defaults, the seller can evict them from the home. They don't have to go through a foreclosure process, and the buyer forgoes all of the monthly payments that it's made up to that point. So you have to understand and negotiate a default clause within that land contract, especially if you're the buyer. So let's talk pros and cons within these terms of a land contract for both the buyer and the seller. So obviously one of the benefits if you are buying and you're entered into a land contract is you don't have to utilize a traditional bank. Maybe you've gone to the bank and they're saying, listen, we can't loan any money to you right now. You don't have enough credit history, or your credit is poor, or you've been through a short sale or a foreclosure, so we can't lend to you. So this allows you to buy a home and enjoy home ownership without utilizing a bank. So that is one of the main advantages for the buyer utilizing a land contract. Another benefit is minimal money down if you're the buyer. Many times in a land contract, you can negotiate very little down payment and closing costs, if any at all, because many times the seller is trying to be creative to sell their home and get it moving on the market. So there's some ability to negotiate if you're the buyer to eliminate any sort of down payment or closing costs. Another advantage if you're the buyer, you get to enjoy a home that you otherwise would not be able to get because you can't get traditional financing. So that's a great advantage to the buyer as well. So what are some of the advantages to a seller. One of the biggest advantages if you're the seller is you are able to move your home. It might not be what you wanted, you're not going to get money up front, but you are going to be pulling potential buyers off the sideline who maybe can't get a traditional loan, and your home might move faster than somebody else who's just waiting for a traditional buyer to come out of the woodwork. And if the economy is slow or the market is slow, it's a great way to pull those investors or those buyers off of the sideline through creative seller financing. Another advantage to the seller is you can actually charge higher interest rates. Remember, you're taking a little bit of a risk dealing with somebody who isn't credit worthy or who cannot get a loan, and you are then able to charge a little bit higher interest rates and maybe make money every single month. The other advantage as a seller, you don't necessarily have to pay off your mortgage. You can do what's called a wraparound mortgage, meaning that you receive that monthly payment every single month from the buyer to you, and you can wrap around, pay your mortgage, and keep what's left over. But one thing that is vitally important to remember when you enter into a land contract, whether you're a buyer or a seller, is a land contract does absolutely benefit the seller. As I mentioned, the seller has the ability to evict the buyer from the property if they ever default, which means the buyer forgoes all the money they paid to that point. If we're talking about land contracts and the terms within a land contract, what strategy in real estate would be best served with a land contract? And that is a slow flip. Now, a slow flip is an interesting strategy, right? I think when most people think of flips, they think of things happening fairly quickly, within a couple of months period of time. With a slow flip, if you are the investor, you're looking for a property that's between $50,000 to $100,000, and you're negotiating like a pro in order to get that property 25 to 30% below asking price. Now, because of that, you're not going to have a ton of accepted offers, but when you do, you buy that property, you're typically using private money to purchase that property outright, which gives you some negotiating power, and then you turn around and sell that property at market value or a little bit above market value, utilizing a land contract with all the terms that we just talked about. Now, the overall goal, if you are the investor, is to be able to finance this property from your private money lender where it's amortized over, say, a 5, 6, or 7 year period of time. So you're financing as if it were a vehicle, right? Typically, you buy a car, it's paid off within 5 to 7 years. The same thing on a slow flip to the private money that you're borrowing. So that payment, whatever it is, you got to turn around and find the buyer that's going to buy the property from you, and you amortize it over, say, a 15 or 30 year period of time. And you want that payment to be equal to or greater than the payment you're making to the private money lender, because you don't want to have to come out of pocket every single month to make up the difference. So let's say that you do that, and let's say that the payment that you're paying to the private money lender that's going to have this property paid off in 6 years is maybe it's $950 a month. And if you're selling it to somebody with a land contract in those terms, you want that payment to be $1,000 or greater, and then you pocket that difference. Now, you might say, that's not a ton of money. I'm not cash flowing hardly anything every single month. But here's where slow flips get powerful, is when your term is up with your private money lender after 6 years, every single month after that, you have $1,000 a month coming in from that property. And if you were to do 10, 20, 50 of these, imagine how much money would be coming in. I know an individual who has done 150 of these slow flips, and he's starting to get towards that 5th, 6th, and 7th year of his term to his private money lender, and he has a ton of cash flow coming in. So this is an amazing strategy that utilizes land contracts. I actually looked at this strategy and said, what can I do differently to make it cash flow? And I came up with a brand new strategy called cash flow flipping. And if you're interested in learning exactly how I do this strategy that works in any market economy and brings in a ton of cash flow every single month, plus it builds wealth, go ahead and click on this video right here. Once again, thanks for stopping by. Have an amazing day.